Hey, what's up, my friends? How's your evening going today? So, I wanted to talk a little bit about investing in the stock market. So, I had a couple of my friends ask me, well, what are the first steps on investing in the stock market? And when I am in the stock market, what should I even invest into? Can I lose my money quickly? Is investing in the stock market a safe bet? And to answer that question right there, is the stock market safe? It is safe if you play it safe. So that's what I want to bring up my next topic, and that's the types of ways you can invest. So I have three different categories that I want to identify, which are just the types of risks you would undergo when it comes to your investment career. So the first one being is safe investing. And these are things such as like index funds, which have very low volatility. The chances of losing money are low. You got medium risk, where now you're starting to face a bit of volatility, and your chances of losing money are starting to go up, but you can also gain a bit more. And then you have the highest, which I think is like things like day trading, the highest risk, where you can make thousands in maybe a week, but you can also lose thousands in a week, depending on how the volatility is. And normally when it comes to these higher risk trades, now you're reversing a very high volatility. So let's talk about the first one, where it comes to safe investing. And I feel like safe investing is something everyone should follow through with when it comes to initially building your portfolio, and even in the future constantly building your portfolio with these safe investments. And what you want to focus on safe investments are things known as index funds. Now, what is an index fund? Well, an index fund is a stock which just tracks a couple other stocks, or in the case of Vanguard Total Stock Index, or VTI, it tracks the whole entire stock market. In another case, let's say VOO, this stock, which is an index fund, tracks the top 500 companies in the stock market, VOO. And these are all great investments to buy into or purchase a share of. And the advantage of going with these index funds is you would suffer very low volatility. So the chances of you losing money after purchasing a share are very slim. In fact, most index funds have only shown growth, and they will continue to show growth as time continues. Now, the average growth rate for an index fund like VTI is normally 8% in a year. So it's not that great, but it's still growing. And if you invest into it, your money will grow alongside it. So let's say, for example, let me just go on Robinhood and look up the VTI stock. So a share of VTI, let's say you were purchasing one share, is about $169. Let's say I only got one share, and now I just wait. I just hold my share for a little while. And that's the whole key point when it comes to investing in index funds, is you want to hold your shares. You never want to sell them. So you're expecting to hold these shares for maybe 10 to 20 to 30, maybe even 40 years, and even longer if possible, because these are great investments to make. So let's say you bought this share at $169.09. Next year, what you would expect it to be at is probably maybe $230. So about $70 gain in a year, which isn't really that great. But if you just have one share of it, the point of continually investing annually. So you always want to just keep investing your money. So let's say maybe 10% of your paycheck monthly. So in that sense, for me, I normally invest $100 every month into my Robinhood account, and I deviate my funds into different stocks, and one of them being Vanguard Total Stock Market. So another advantage of holding an index fund is the dividend. Now, what is a dividend? A dividend is a payout to the stockholder for simply holding on to their share. So, simply just for purchasing the share and never selling it, this company, VTI or Vanguard, will pay me this dividend percentage just for holding their share and never selling it. So in this case, it's 1.73%. So 1.73% of that one share I own of VTI, which was at 169, the dividend being 1.73, I expect a $2 payout from this dividend. So now, when would they even pay me? Well, in the case of VTI, they pay out on a quarterly basis. So about every 3 months, they will pay you this dividend. Now, this dividend is based off the amount of total shares you have in the company. So let's say I have 5 shares of VTI, which would probably be a value of maybe $700. They would pay me this 1.73% dividend of that $700, in which case it could be maybe probably $14, around that, and I would receive that quarterly. Now that's the advantage though. What most people will do to achieve passive income is use dividends. So let's say you have a total investment of $600,000 diversified between many different index funds and stocks. The dividends you receive from your stocks, if you have about a total investment of $600,000, could equal out to about maybe $1,000 a month, maybe $500 a week sometimes, depending on your investments. And a lot of people will use that as retirement money or as passive income. So if you manage to achieve this early on, you can now retire and just receive money based on your passive income or these dividends, which is highly advantageous and is a goal that many people are striving to achieve. And I recommend the same for you, is that you try to look into buying more dividendly rich stocks. So I want to talk about the next risk that you could undergo, which is more of a medium risk, but with a bit more medium reward. So these are things that are just corporate stocks, individual stocks, similar to Apple, Tesla, Delta Airlines, American Airlines, just Intel, just to name a few. And these stocks suffer from a thing known as volatility, and this is where you could start losing money in the short term. Normally in the long term with stocks, you will see them go up. So if you just plan on buying these shares and holding them 10, 20, 30, 40 years, you're going to make money in the long term. But if you're looking at more of the short term, like let's say in a month, you can see certain stocks might actually even go down for similar, or for example rather, if you look at Apple, earlier this month, it was at about $124. But today, it's at $106. So now you have a load of shares in that. Let's say you have like 15 shares of Apple. Well, that's about what's about a difference of maybe like 15, and you have 10 shares, that's a $150 loss. So you suffer from volatility in the short term. But in the other side though, let's say a company like Tesla, which earlier this month was at 378. Let's say you have 10 shares of that. Today is worth $449. So 10 shares of that split, or of that difference, is probably like a $60 difference of 10 shares. You just made $600 in about a month. So it's a lot more return as opposed to an index fund where in a couple months with Tesla, or in a month I made $600, or just $60 with one share, as opposed to an index fund. In a 1 year, I might make maybe only a $40 return. So that's the advantage, is that more money, but also you have that risk. Another more riskier investment you can make, not necessarily highly risk, but there are things known as option spreads. And unfortunately, I'm not going to go over them in this video. I'm going to have a whole separate video dedicated to just options, because there's a lot to unpack when it comes to options. But that is definitely a more, it could save you a bit, it could make you more money on the short term, but also lose you a lot more with a more medium risk approach. So now let's talk a little bit about high risk. What are high risk investments? So the advantage of high risk investments is that you can make a very high return. So for instance, day trading. Now, let's say you have 100 shares of Apple, which let's look at Apple. You got 100 shares of Apple, which was at let's say this morning, $111, and you have 100 shares of that. That's about $11,000. So today, it is at the end of the day, rather, it's at $107. So that's a $4 difference, but you have 100 shares. So you just lost $400 in one day. But now, if you look on the other side, something like Tesla, in which case you have let's say it was at 387 in the morning, but at the end of that day, it's at 440. So now you're talking 100 shares of that. That's about $3,000 in profit. That's a $30 difference. So it's definitely advantageous, but higher risk. So that's one of the bigger things. Now, another riskier method you could take are just straight options, known as calls and puts. And like I said, I'm not going to go over them in this video, but you could risk maybe $300, but for a gain of about $700. So I hope this video was informative. I plan on making a couple more videos after this, trying to describe option spreads and options. Just really getting into that, because options are they're a very good way to make some money on this while you're investing. It could be beneficial if you learn the proper ways to do it. So if you have any questions, please ask me. Add me on my Snapchat. You can message me there. And if you like this video, if you press the like button, I'll know that you're interested, so I'll make more videos. So have a great day, everyone, and I wish you guys the best in your investment career.